Great to be here, great to be back at Diggers to really update everyone on the progress and the significant progress that's been made at the Jaguar nickel sulphide project in Brazil. We really do believe that we're on the cusp of a very serious operation. We're doing all the work now to pull all of that together, and hopefully over the course of the next 15 minutes I can give you a sense of all of that. You've seen plenty of these over the last 3 days, and I'll keep moving through that. But importantly for us, we're trying to build a strategic mineral business in Brazil. We're focused on the Jaguar nickel sulphide project, and it really is becoming, or has become, a world-class project. Earlier in this week we put out a new resource upgrade for the project that now has it sitting at about 1.2 million tonnes of contained nickel sulphide. So we think that that is in pretty rarefied air. We don't feel that there's too many sulphide projects with the size and scale, and combine that with what we've demonstrated over the last month, where we've released our feasibility study, and we've got extremely good operating costs. We've got a very competitive capital cost position, and we're doing that from a position where we're located in an environment where there's access to a huge amount of infrastructure in the Carajás Mineral Province. So we've got all the attributes here for what will be a very significant project. I guess right now we're operating against a backdrop where nickel is, the price of that is sort of impacting sentiment. There's a lot of material coming out of Indonesia that has depressed prices, but fundamentally for Centaurus it's always been about being able to compete with Indonesia on cost, and if we can compete on cost then we will shoot the lights out in respect to our emissions footprint, given that most of Brazil's power is coming from renewable, principally hydro sources. So there's a whole bunch of factors that go to this project that says that this will be developed, even against the backdrop of what is happening in Indonesia, and unfortunately what is obviously happening against the Australian sector. We are ASX listed, but we have a very different project style and I guess a project economics compared to a number of operations around here. We have a market cap right now of 180 odd million dollars, and I think that's just to park for the rest of the presentation around what we've seen from the feasibility study economics. Obviously nickel price impacts that. We feel like we will have huge leverage towards nickel prices as they continue to rise, and I think they will rise progressively. We've seen a lot of the supply-demand side of things in Indonesia impact that. What I feel like is that the demand side needs to pick up, principally out of the US and the EU locations. If you listen to and look at some of the stats that are through there, there is still a huge amount of gigafactories that have still got to be rolled out in those jurisdictions. They are still going to require a huge amount of nickel, and I guess a project like ours with huge mineral endowment, located where it is in northern Brazil with close access to North America and the EU environment, puts us in a great position to be supplying these gigafactories as they start to get rolled out. We are seeing strong, I guess, partnering, offtake type interest for the product that's going to come out of Jaguar. I think there is a general perception amongst the groups that I talk to that there is a shortage of nickel units. So I think there's quite a big disconnect that we're seeing between, I guess, the equity players and where the short-term price impact is, and where the strategic market actually sees the nickel and the direction of travel in relation to that. So we have a strategic process soon to start, and with that we would expect to see very strong interest for the nickel units that we will produce here at Jaguar. If any of this comes to fruition and the size and scale, and even if you say, okay, we're going to halve those estimates of what it is, it still says that there's another 80 odd projects the size of Jaguar that need to be rolled out over the next 10 years or so, and it's very difficult to see where that's going to happen given the time that it takes to bring some of these projects to fruition. Just touching specifically on Brazil, some of the economics that we are benefited by is a favourable tax system. We have a 15% tax rate for being located in the Amazon region of northern Brazil. That is highly advantageous towards our post-tax economics. The royalty system in Brazil brings along the communities for the project. 65% of the government royalty goes straight back into the municipality where the project is located, so you do get very strong buy-in from the local communities, so much so that we've actually had the public hearings for our project. We've had the, I guess, the key environmental approval granted to us, which in Brazil is called a preliminary licence, which is the approval of our environmental impact assessment, and that all came back on the close community consultation that we had with the local region. So it's historically been a region where you could go out and do a bit of farming, but in more recent times it's becoming quite a hotspot for new projects. If you look at the Carajás, it's about 150 k's across by 100 kilometres north-south. Massive deposits there. You would have heard of S11D and Salobo that Vale operate there. There's some other projects more recently that was put together close to where we are. Aero Copper, TSX listed company, just built a 4 million tonne copper float plant only 40 kilometres from where we are. They did that in 20 months and they did that for a very competitive capital cost. And we'll be looking to do exactly the same thing with a similar size plant, similar type of process flow sheet, obviously just a different commodity. So with that and the $500 million that Vale's spending at Onça Puma, putting in a second rotary kiln there, we see that there's a huge amount of activity in the region where we are. And those towns of Tucumã and Olanja do Norte, where we base ourselves, have about 35,000 people each. Ready-made workforce, obviously more and more mining type people coming to that region because of these other projects. So we're able to leverage off that to bring our project to fruition. On the bottom right there, that's just Aero's project. When I was there in January, February, they've now actually produced first concentrate from there in July. So that project's now up and running. You can see some of the ports, and I guess importantly for us, it's the hydropower in Brazil, which is principally driving our low-cost environment. We will join up to the 230 kV national grid as part of the project development, and with that we will have relatively low distribution costs, ultimately leading to a position where our costs will be around 3.5 cents a kilowatt hour for power. And so I always get pushed back a little bit here. It's like, how can it be so cheap? But it is a function of the hydropower that is there, the fact that we will be 100% renewably sourced power in Brazil when we actually bring this project on stream, because we can go out into the open market. And all of those things have led to the economics that we'll talk through now. So we completed the feasibility study about a month ago. The costs are around $3.60 per pound on an all-in sustaining basis, on a contained nickel basis. So really, really good position from a cost point of view. Capital costs around $370 million US, leading ultimately to economics with a post-tax MPV of just under $1 billion Australian dollars. So those sort of things, I think, are key to getting this project up and running, and I guess the partnering conversations that we're going to have as we look to fund the project. So I'll talk to just a few of these things specifically. Operating costs, you can see the breakdown there, whether you pick your poison on how you like to think about costs, but $1 per tonne of ore milled or $1 per pound of nickel in concentrate. But you can see the highlight there is really on the processing costs, which is fundamentally driven by power, the size and scale of the operation, the fact that we are going to be open pittable operations, and ultimately that most of our costs are in Brazilian reais, and when you bring that back to USD, we've got quite a favourable environment for that. So $2.30 per pound on site and $3.57 per pound delivered to the customer. And when you look at that around the cost curve, you know, we're in a really strong position there to be competitive, and that's one of the key things that the partners that we've been talking to about the project wanted to see. They knew that we had a long life project, we knew we had a large resource, and the production profile was there, but we needed to demonstrate that we are going to be low cost. We've now been able to do that, and then those sort of customers, off-takers, usually groups that are in the downstream, they can now take confidence in the product that they can receive, and that we will be in the market at all points in the cycle. Capital cost-wise, payback's about 2.7 years. As I said, a 3.5 million tonne per annum float plant that we're going to be putting in place there. A couple of the numbers there, bit of extra going into the tailings dam, so the IWL, bit of mining work at the front end of the project. And the other side of it is investing a little bit more capital into the power line just so that we can access the 230 kV national grid and avail ourselves of the lower distribution charges over such a long life. So from a capital intensity point of view around undeveloped nickel projects, you can see there sulphide and laterite projects, we're very well placed in relation to that, just under $20,000 per tonne of annual capacity. Emissions-wise, we will be 100% renewable power. That leads us to very low carbon emissions at the mine, just over 1.5 tonnes of carbon per tonne of nickel. But even after allowing for the downstream and the logistics, we're sort of just over 7 tonnes of carbon. So again, extremely good footprint, very competitive across the board. And I think whilst that's become less of a focus for the groups that we're talking to, it still is an important part at play. Economics are first, emissions are now really, I guess, the second point to that. But we know that we're going to be in a very strong position relative to Indonesian supply. That's going to be one of the key attributes that we have when we're talking to partners and off-takers, that we can demonstrate we are very different from an emissions perspective. And so now just talking about the resource. When we did the feasibility study, our resource was sitting at about 950,000 tonnes contained. As I said, on Monday we put out a resource upgrade. Great day for it, but never mind. So we're now sitting just under 140 million tonnes, 0.87% nickel, just around 1.2 million tonnes of contained. As a sulphide project, there just really isn't many projects like that on a global basis. It does give you the opportunity to have a very nice production profile, just shy of 20,000 tonnes per annum, but it also gives us plenty of upside, plenty of opportunity to bring in partners. And you can see the huge amount of resource growth since we acquired this project about 5 years ago. You know, I was here at Diggers. We actually did the transaction with Vale at that time, and since then we've really made massive inroads and continue to demonstrate that there is more mineralisation here. So whilst we've stopped drilling, we know that the mineralisation is still open and we've still got the opportunity to find more if required. So there's a few things that we've got to do now in the lead up to investment decision. So we're going to just do some optimisation around the mine plan. So when you look at that resource, you know, when we run a higher cut-off grade, there's still over 500,000 tonnes of contained nickel metal running at about 1.5% nickel. So that's important to us. Of that, there's about 8 million tonnes sitting in the top 100 metres. So we'll go back and just have a look at how we might fine-tune that mine plan, allow us to sort of bring forward lower strip material, potentially take in some of this higher grade material into what we're doing. On the basis that when we released the feasibility study, it really was based on some previous work looking at us going into the downstream to produce sulphate. So in the interest of time, we've sort of brought that forward and pushed that out, but there's now the opportunity for us prior to FID to actually go and have a bit more of a tweak of the mine plan and see what we can achieve. Outside of that, there's also a lot of mineralisation that sits at depth. So we've got the pits, those pits that you see on screen, they're going to be about 3 kilometres of strike. So just have a think about what we've got here in the super pit in Kalgoorlie and how big that hole of the ground is. This will probably be about 2/3 the size of that when it's all said and done, just in the open pit side. But as you can see, a lot of high-grade material sitting underneath the pit. We'll go off and do some scoping study work. We did not include any underground material in our feasibility study economics. So when we think, as we think about this, some of this material sitting just under the pit, we'll run a scoping study, see what those economics tell us, but we would expect that those units will also be very economic and favourable to the overall project development. Financing-wise, we're working with Standard Chartered Bank to run a formal partnering process. About 18 months ago, we acquired the offtake rights back from Vale, and that was a pretty strategic move, because it now enables us to be able to go and have conversations with the various offtake groups that will ultimately be able to bring project participation and project funding for us. You've seen our market cap. That's not something that we're going to go and fund the project off at an equity level corporately. That does not make sense. We'll get a much better look through on valuation by talking to partners, getting them to come in at the project level for minority position. And the conversations that we've had to date suggests that we're in very good shape to attract that interest, given there's so much shortage of nickel at a strategic level in the market. Timeline-wise, we've got through to the second quarter of next year to make the investment decision. We'll get the final stage of the environmental approval through by the end of this year, mining lease to follow in the first quarter of next year, funding with this strategic partnering process going on over the next 6 months, and we'd like to think that we've got a pretty good answer on where that direction of travel is as we get towards the end of the calendar year. If all that goes to plan, we've got a 2-year construction window. Aero have demonstrated they can build a project of this size and scale in about 20 months. So there's the milestones that we sort of should be striving for, but we're giving ourselves 2 years and looking at first production in the back half of 2027. So just to close that out, great asset, world-class scale resource, very decent production profile, highly sought after product, low carbon footprint, good environment, a lot of infrastructure, low cost, low capital intensity. So in my mind, it's got everything that groups are looking for to take this forward. Nickel price today is not very good, but we would still be making about $4,000 a tonne margin today, even on the nickel price where it sits based on our feasibility study economics. So we know that we're going to be in the market all day, every day, once we're actually up and running.